Gold just hit $4,500 an ounce, and this fund is up 80% in the past year. But the fund that's supposed to be the small, scrappy way to play that rally isn't so small anymore. Meet GDXJ, the VanEck Junior Gold Miners ETF. It launched in 2009 and tracks small and mid-sized gold and silver mining companies. The exploration and development names sitting one level below giants like Newmont and Barrick. Gold just crossed $4,500 an ounce, and the whole mining sector is riding the wave. Its big sibling, GDX, pulled in over $400 million in August alone, the strongest month of inflows since February. GDXJ has ridden the same wave even harder, gaining roughly 80% over the past year and now managing more than $9 billion. Here's why juniors move faster than the big miners. A senior producer like Newmont already has mines running, so a higher gold price mostly expands the profit margin on gold it's already pulling out of the ground. A junior miner might be sitting on an undeveloped deposit that was worthless at $3,000 gold and suddenly looks very economic at $4,500. That optionality is the entire pitch of this fund. Here's the catch. VanEck doesn't put in the marketing. GDXJ has grown so large that it's running into a capacity problem. There simply aren't enough small, liquid junior gold miners to responsibly fill a $9 billion fund without over-concentrating in a handful of stocks. So the index has quietly widened its market cap bands over the years, pulling in bigger, more established mid-tier producers to make room for all that money. The fund's own success is diluting the small-cap, high optionality bet that made people want to own it in the first place. That's a lesson worth remembering with any thematic fund. When a niche strategy gets popular, the fund itself can outgrow the niche. None of this makes GDXJ a bad fund, but it does still come with real risk. Junior and mid-tier miners carry higher operating leverage than the majors. They burn cash developing new deposits, and they depend on capital markets staying open to fund that growth. Even in a strong gold market, this corner of the sector can drop 20% or more in a matter of weeks. The 80% one-year return doesn't come free. At a 0.52% expense ratio with over 100 holdings, GDXJ is a reasonable way to add torque to a gold thesis. But it's built for investors who can stomach sharp pullbacks in exchange for more upside when gold runs. If what you actually want is calmer, steadier exposure to the miners, that's what GDX, the senior fund, is built for instead. Know which bet you're actually making before you buy the ticker. This is not investment advice, so do your own research before putting money into any single fund. If this helped you understand what you actually own, hit like and subscribe for more of these breakdowns. And drop a comment. Are you buying gold miners at these levels or waiting for a pullback first?